MIS Commodities. Taking a look at the week in review. Let's start out seeing where we close for the week. Starting out in the grains, corn closed 15 cents lower, a little over 15 cents lower for the week, just under $3.90 in the December contract. Beans down 14 cents as well in the November contract at 10.01 and a half. Wheat, September wheat was down 24.5 cents at 5.10 3/4 as a settlement price. Taking a look at the meats, August cattle exploded higher this week, up $3, a little over $3 at 117.80 in the August contract. The July contract is set to expire 92.60 last trade there. The August contract, unfortunately, is down $3.32 on the week at 79.90. Crude at the time of this broadcast is up about two and a quarter right now, right around 46.58, and the dollar looks as if it's somewhere around 80 points lower, around that 94.90 area, still trading at this point. We're in a full-blown weather market in the greens right now. We did see the ranges pop up to the upside of the market here this week. We've seen decent corn and November beans make new highs only to close lower on the week. We've seen the volatility continue to expand. Weather market, the uncertainties of deteriorating crop conditions in the Dakotas, western Iowa, northeastern Nebraska, and how good is it in the heart of the Corn Belt, and is there too much rain in the eastern part of the Corn Belt? A lot of questions remain unanswered yet at this point, but seasonally this is the time of the year that we do see a decline in the futures markets for both corn and soybeans. From a percentage standpoint, we see a huge decline from the end of the middle of July to the 1st of August and December futures, corn futures in particular. Now, to throw in the middle of this weather market, we did have our monthly supply and demand report, where we incorporate the acres from the acreage and stocks report last month, and also see how we balance out the stocks report on the demand side of the balance sheet. So going into this report that was released on Wednesday, the trade was looking for a small bump up in carryout old crop stocks, and we did get that. Our old carryout was 2.295 billion bushels. We came in at 2.37 billion bushels. Plenty of old crop corn out there, and that came primarily through lowering the feed demand about 75 million bushels. We left the rest of the balance sheet alone, and then we plugged that carryover into the new crop balance sheet along with 1 million more acres from the acreage report last month. That gave us a new crop carryout up there at 2.32 billion bushels. That's up from 2.11 last month. Left the yield alone. Some in the trade were looking for a reduction in yield estimates in this report. The USDA traditionally leaves that yield alone, doesn't do any adjustments until the August report. So that being said, we have plenty of corn via old crop, via new crop, if we grow 170 bushels an acre. Therein lies the problem. We don't know what our yield estimates are due to the variability of the growing conditions so far this year. The trade is probably trading a 65, 67 yield right now. You plug those numbers in there, it still gives you over 2 billion bushel carryout. So we still have some weather in play here yet. All eyes are going to be on the weather forecast this weekend. We're going to continue to watch and see if the 6 to 10, the 8 to 14 day are showing some hot periods, but we are introducing some moisture into the plains as well. So we're looking at that heat still for the most part staying out in the western plains, maybe wraps around into a little bit of the southern areas of the Corn Belt in weeks to come. But again, that thing can and has flip-flopped quite a bit. It's been a very fluid forecast. Taking a look at the beans balance sheet, the trade was looking for a decrease in the carryout number for soybeans old crop, looking because of the strong export program that we've got going on, and we did see it. We did see the USDA increase exports 50 million bushels in this report. We lowered crush 10 million, gave us a 40 million bushel bump. On the demand side of the equation, you take that off last month's 450 carryout, gave us a 410 carryout. We plugged that into the new crop balance sheet. We went from 495 down to 460, playing with some residual numbers in there as well. We left the yield alone there as well, as for the same reason as corn. That being said, the market did react bearishly to the report, or upon the release of the report, but that's also due to the fact that we were looking for higher temps this week and a little bit less rain. All said and done, though very spotty, we did see some better than expected rain in spots, or total precip amounts, and the heat never really cranked up as hot as what was expected here in the heart of the Corn Belt. So that in play, along with a managed fund position that on the Commitment of Traders report released this afternoon, shows that the funds went from a very large short position, I shouldn't say a large short position, but recovered and actually ended up long corn, about 100,000 contracts after being short almost 100 a couple weeks ago. So we've seen a very massive short covering rally, and this is a report through Tuesday, and we've seen that same thing in beans, where they're actually long about 20,000 beans through Tuesday. Since then, we have obviously pared back a fair amount of that ownership in the last 3 days. Again, then we're going to wait and see what Sunday night has to bring. Taking a look at the livestock markets, cattle was able to see a pretty aggressive move the middle of this week. We've seen a $5 rally off the lows Tuesday through Wednesday, and then we stayed fairly soft or quiet the balance of the week yesterday and today. Interesting enough, we're seeing the cutout fall out of bed, down almost $9, about $8.50 in the choice cutout this week. So the packers are losing some of their leverage here, while cash actually traded better this week, up to around 119, 120. There in line, the reason we did see the August cattle futures rally, along with a lot of fund rolling out as well, supported the deferred contracts. They were able to gain and actually are trading at a premium now to the front end here. Interesting enough, kill weights were up on the week. We were looking for a hot week, especially out west. Maybe you wouldn't see the slaughter weights quite as high as what they were. So we're right here at an area of possible resistance on the charts in the August contract. That's certainly something to watch. Early on, cash thoughts for next week is steady at best. Hog futures, the July is set to expire Monday, sitting at a very good premium, in fact a record premium or spread to the August contract. The index is right up there as well. National cash prices, direct cash prices sitting around 86, a little over $86 an acre, and the pork cutout sitting a little over $104 an acre, while we have the August futures contract closed below $80 this week at $79.90. We've seen some very heavy selling on the close today. We do see a fair amount of ownership, large ownership of the managed money in the hog futures, and technically now we are looking at a chart that doesn't look very good. I do think rallies, especially in the deferreds, are to be sold and have been for a while. But we are looking at a very large spread between what cash is trading out there and how the August contract is setting up. I do think that can hold that front end of that contract up a little bit, and I'm looking for that spread to narrow via both ways. It's tough to know if we're going to see it on the cash end or on the futures end, but if we do see a rally in here, we did see kill weights up more than expected this week as well. Taking a look at that fourth quarter production, maybe priced in to some extent, but again, we want to be hedgers there as well as in the cattle market. So if you have any questions about these or any other markets, please feel free to give us a call here at BIS Commodities at 1-800-373-2525.